Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of November 30th, 2025. And in this week's episode, I'm going to take a look at profiting from earnings trades if you're intending to go long on a stock. And we're going to use the example of GitLab in this week's episode. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. And it's going to be a relatively quick episode this week, and I've done many episodes on earnings trades, and I kind of want to zoom in again on earnings trades just because it is the most probable trade that I make, one of the most prevalent ones in my portfolio. And the reason that I do it is a lot of the elevated volatility and premium that gets baked in prior to earnings of all of the underlyings. And I recently did an episode around kind of selling options to go long or getting paid to get that limit order filled. And so this is kind of along those lines where I wanted to go through upcoming earnings and see which one of the upcoming charts looked like most probable to play on a bullish front. Because I want to kind of appeal or kind of go after the type of trader that probably would want to go long on a particular underlying anyway. And so I didn't really want that kind of neutral opinion. I wanted to kind of have more of a bullish tilt based on the chart and the price action. And so I'll take you through how I kind of arrived at GitLab a little bit. Which is the underlying that will have earnings next week or this upcoming week. And that elevated volatility, what we are going to do is we're going to sell it to profit off of that volatility and might get to go long. And if we don't get to go long based on the price action post earnings, at least you'll end up with a pretty decent chunk of change that's going to be added to your wallet. So before I hop into the option chain here to call out a couple of things, really, you can choose any strike that you want. You can choose any expiration that you want. But when your strategy is around mine, where you want to capture the most volatility or the most extra premium, there's two factors that kind of go into the premium that goes into the option price. And that is both the volatility and the time to expiration. Those are really the two factors that are going to have the most influence on the price of the option that we're going to sell. And so when I take a look at the chain, the first thing I want to try to do is decide when do I want the expiration to, what option strike price do I want the expiration to expire? And basically the one that will always have the most volatility in it is going to be the one that expires on the Friday of the week that the earnings announcement appears. Because it's that earnings announcement that's going to drive a lot of uncertainty, and that uncertainty is going to elevate the volatility. So if you want to maximize the volatility, that's always going to be that Friday, the week of expiration. And I'll show you a slight comparison if you go out a week where you can still get a decent premium, because what you're going to start doing is transitioning the premium to more the length of time before that expiration. The volatility will be a little bit less the week following earnings announcement, but you're going to be longer in time, so it's going to have more theta premium. And I'll show you kind of that trade-off. And then the other thing that we're going to take a look at is what strike do you want to sell? Because keep in mind, if you end up in the money, you are going to be assigned these shares at that strike price. And so you want to make sure that the price that you're selling at is a price that you're okay to pay for those shares, even if the stock price drops a little bit below it or even significantly below it. You have to be okay to own the shares at that price. Those are kind of a prerequisite anytime you go to sell premium. And then once we kind of dial in that, we're going to take a look at, well, how much do I sell? Do I sell 1 contract, 5 contracts, 10 contracts, 1,000 contracts? And really what's going to drive that is really your portfolio size. Because these are leveraged positions, it could be very tempting to sell more than you can afford because it's leveraged. It's a little bit harder to see what you can afford. So you kind of have to have that number ahead of time, and we'll use that number to decide how big of a position do you want to open up. All right, so the first place I want to start is screening for upcoming earnings. And I'm not going to spend a ton of time on this. You can go back to previous episodes. But really, what I'm looking at is what is coming up for earnings next week, what has the most volatility, and let's sort it in that order. And so this is a criteria that I have put up. And then I have this sorted by IV percentile. IV percentile is the implied volatility percentile. And so it's not the straight volatility, but it's how much volatility is there relative to the historical appearance of volatility. And the couple factors I'm going to look for is the actual spot volatility, which is going to be in this implied volatility column. And I'm also going to look at the volume column. So I'm going to sort it by IV percentile. So the most volatile names are going to be at the top, and they're going to decrease in volatility relative to where they have stood historically. The next column over here is the actual spot volatility. And so the higher that number is, the higher that volatility is in that exact name. So when you're on a very high end of IV percentile and you have a very high spot volatility, you are really, really in an overextended state. And that is the type of play that I want to get into. And then the last one I'm going to look at is kind of this volume column, because this is going to be a good indicator of liquidity. So if the volume is kind of low, it's not going to have good liquidity. It's not going to give you good entry and exit price. So you're going to stay away from it. So if I take a look at this, I'm also going to then look for names that I might have heard of. And you can see as we kind of come down, we start at 97 percentile, 90, 85, 81, 78. But if you look over here for the actual spot volatility, you're going to go 50, 68, 86, 79, 64. So I'm going to zero in right here to this. American Eagle Outfitters could be another one that we could look at, but the where I'm going to zoom in is this GitLab. So GitLab currently trading at $41 a share. It's about the 81 percentile of IV relative to history, and it currently has a 80% spot volatility right now, and a good 2.4 million shares traded as volume on the most recent trading day, which was kind of a half day on Friday of the Thanksgiving week. So this is where I'm going to zoom in at. This is the one that I want to kind of take a look at the chart. Now, you can kind of zip through that list that I had, and you can pick different charts to look at. The reason that I stuck with this one is this is the weekly chart over the past year. So this has given me the price action on daily candles here over the past year. You can see the high is around $74 a share. The low is about $37.90. This was back in April after the first tariff scare, and you can see it's kind of been trading in a range since then. The upper end of the range is around that mid 50s, low 50s price, and the bottom end of this range is around that $39 mark. And if you recall, we're trading at 41, so we're kind of bouncing off that bottom end of the trading range that we've been in all year. So this price action to me kind of says that there's a lot of pent-up volatility. We're kind of at the bottom end of the trading range. And so to me, this is really looking for a springboard off of this rejection of this low end of the trading range, which is why I'm bullish on it. We could pull up other charts and you can make your own price action determination in there. The other thing that I really like about this is towards the bottom here, you'll see this red and green markers. And everywhere you see a bubble up here, these are earnings announcements, and you'll kind of see a little cliff down here on the volatility. So this is showing me that after an earnings announcement, there's very good volatility contraction. And these are all just hallmarks of stuff that I look for when I go to get into some of these earnings trades. Because one of the prerequisites of what I wanted to call out here is a bullish trade. I wanted to find something that the price action indicated it might be time to buy this. And instead of buying this thing ahead of earnings and paying for kind of, what kind of surprise you might get, let's go ahead and collect a little bit of money to compensate us for kind of taking that risk ahead of earnings. And that's really what I want to zoom in on when I talk about the actual option pricing around this earnings announcement. Okay, so now we're pulling up the option chain around GitLab. And the first thing that I want to kind of call out is we've got these different dates over here on the left. And each of these dates is an expiration date. So December 5th, December 12th, December 19th, December 26th, they basically have an expiration date every Friday. And then on the right, you're going to see a percentage. And this is the implied volatility that is in that week's option chain. And you can see that the earnings are actually December 2nd, and the most volatile chain is the one that expires December 5th, because that's the Friday following the earnings announcement. That's at 127% volatility, which is about double what the normal volatility is. And the reason you can say what is the normal volatility is you just simply go down the chain further out in time when you're away from any uncertainty, away from any of those earnings events. And that's going to show you kind of that steady state volatility, which is in the mid 60s. And so you can see 127 is about double that normal volatility. So this is the option chain that I want to zoom in on to take a particular trade, a bullish position on GitLab. So we're going to click into that week's expiration of December 5th, and we're going to start looking at the chain. And we're going to focus here on the right side of the chain, which is the put side. That we're going to sell a put, which basically means if the price falls below the strike that we choose, we will be obligated to purchase the shares at the strike that we end up selling for. And I'm going to kind of scroll down here because we're trading at 41. So this 41 is going to be the one that is at the money. And so the most premium, the most volatility is going to be right here in that $41 a share price point. And really, here is where you got to ask yourself, what am I willing to pay for GitLab? So if you looked at the price action, we were kind of bouncing off there around the $40 mark is usually where it kind of bounces off from, although it's traded down to about 38 as the low, or 37.90, I think it was. This is the strike here in the middle. And then this bid and ask is basically where that option is selling, probably at a midpoint between these. And so you can see if you went right at $41, you could collect probably around $265 in premium. That is $2.65 per share in the contract that you would collect. Contract is worth 100 shares. So you would pay for 100 shares. You would be collecting about $265 if you sold that. Now, you could do a couple things here. You could get really bullish and you could sell something that's deep in the money. What I caution against that is you might think you're collecting a ton of premium because you can see here at, $45, you're collecting over $5 for selling that. But the reason I want to caution you a little bit, because that is also carries intrinsic value. So that's the delta that is between where the stock is currently trading at and where that strike price is. So because we're trading at about $41, a $45 strike is going to carry $4 of intrinsic value because you're in the money by $4. So the amount of premium there is not actually as much. You'd have to subtract $4 from that to know what is the extrinsic premium value put into that. Whereas if you go the other way, you have less probability that the price is going to fall below that, but everything out of the money is all extrinsic value. None of that is intrinsic. So this is all premium. And so if I was to look at this, when I play something bullish, I tend to sell around a 25 to 35 delta. And that basically is the percentage of probability of being in the money. Which means I would only have really a 35% chance of being assigned if I sold a 35 delta, which happens to be the $39 strike. I'm kind of the reason I zero in on that is, one, you also have the probability that you will be out of the money and then you profit from that. And then I want to pick a strike there that I'm okay to pay at. And so what I got to do is in that cost basis calculation, we take this $39, we'll probably end up selling that for probably around $1.85. And so really the cost basis will be $39 minus $1.85 would be the entry price that we would end up paying if we got assigned. And so you kind of have to factor that into where do you like it? Do you want to pay $39 for a share of GitLab? Or do you want to pay, you really have to think it's 39 minus the premium that you collect. Or maybe, you're real happy around that 41 where you can collect maybe $2.65, take that off the $41 strike, and you're really sitting at kind of the all-time or the 52-week low of GitLab. And that's really up to you on where you want it. How bad do you want to get assigned? I would say if you want more chance of being assigned, you're going to creep up on the delta. If you want just collecting that raw premium on the chance you get assigned, and you're okay with that, then maybe go a little bit lower on the delta. So for this example, we're going to stick with mine where 35 delta is about the top end that I push things when I'm bullish. If I was playing both sides of the earnings, I would step further away. But because this is a bullish trade, I would go ahead and I'd look at selling the $39 strike. So the next part of this is to decide how big of a position do we want to take. And so if I tack on the $39 sell, I'm going to need to pay attention down here to the amount of margin and buying power that this is going to consume. And the amount of buying power that you're going to want to put in here on these trades is really going to be relative to your portfolio size, your risk tolerance, how big of a position that you want to hold, what percentage of that position is going to be in your overall portfolio. For me, I like to target around a $4,500 to $5,500 buying power hit. And so for this one contract is going to take about $1,100 of buying power. And so I would go ahead and see what does this look like if I go ahead and sell about 5 of them. So 5 of these contracts is going to basically take about $5,500 in buying power. And you have to remember that that will put me on the hook to purchase 500 shares at $39 a share. Now the cost basis will be a little bit less because I'm going to collect about $1.85 on this. But that would be about a $19,000 position on that. And then depending on your leverage and your margin, you're probably looking at being able to pony up about $10,000 or about 50% of that before the margin is in there. And so depending on your portfolio size, that might be in your realm of 1.5% to 2.5% per position. That happens to be where I'm kind of comfortable with my risk tolerance and stuff like that. So that's where I would size this at. Now, the volatility here is basically pricing in about a $5 move. And so at $5 from 41 says, hey, we could be going as low as 36 and maybe as high as 47 or 46. So the next thing I want to kind of do is pull up a P&L probability here based on this strike price of 39 and just kind of show you what that profile looks like. And so this is a P&L chart based on that strike price. And this blue line here is the profit and loss at expiration. And then these little kind of hash lines are basically your probability of landing in these different ranges. And so what this is really calling out is that while my strike is at 39, because I'm collecting premium, my cost basis will allow me to come all the way down to a little bit above $37 a share before I'm actually negative or a loss on the trade. And that is about a 10% move from its current 41.10 strike. So this is a 10% drop, still has me at a break even. And remember, I want to be bullish on this. I'm bullish on this. I'm looking to go long GitLab. So if I came down here and got assigned, I'm not going to be sad because I want to be long GitLab. I am picking up this at a discount. But what this is really calling out is that there is effectively a 75% chance that I will make money on this from the probability of where the stock price will be at expiration. And that's what these little yellow numbers are up here. There's basically a 25% chance that I will be below this dash line. And this is also happens to be where my P&L is negative, which means that this section, which is, a 10% move, a plus 10% move, or a greater than 10% move to the upside, you add all those together and you're going to get 100 minus the 25. So that's going to give me a 75% chance to be anywhere along this profit line. And the max profit along this profit line is really going to be that blue line. And that is $925 at that $1.85 if I was able to sell it for $1.85, which is about the mid price of the $39 strike. And so this is going to be a pop of a trade. It's going to be over after earnings announcement. Volatility is going to absolutely collapse, and the price is going to land wherever it will land, with a 75% chance of being above $0, above a zero cost basis. So 75% chance of profit, ranging anywhere from no profit to the majority of this is going to be at that $925 area. Okay, so before I close this out, I do want to circle back here and go back to that point that I said picking your time to expiration is also going to influence this trade a little bit and the premium. So I zoomed in here on the highest volatility, the week of expiration. If you go out 1 week, the week after earnings, you still see that you carry a 98% volatility. That's still slightly elevated over the mid 60% of its standard volatility. So let's go ahead and click into that. And let's go to the exact same strike of that 39. Notice that it is still very, very similar to the same delta. So this is a 36 delta, so almost the same probability as the week before, but you're going to pick up slightly more premium. Now, the spread is a little bit wider here, which I'm not entirely a big fan of. Now, the market is closed at the moment of this recording, so this probably would tighten up a little bit. But when you get outside of that week of expiration, that's when your volatility, or sorry, your volume is going to kind of come down, and this spread is going to get a little bit wider. So I normally don't like that type of spread, but you can see that splitting the difference between 190 and 270 probably is going to land you around a 215 fill, 215, 220 fill. And you know that that's a little bit better than the 185 we were looking at before. Now, more of that is going to be based on the time and not the volatility. And so what I want to play is that volatility contraction, which is why I'm going to look at the week of expiration, because that volatility is going to absolutely evaporate the fastest. Volatility will evaporate from these future expirations, but not as much. So if you get an 80% contraction of volatility week of earnings, you're probably going to see about a 60% or a 50% contraction in volatility for the week after, which is fine, but you just have to know that the bulk of the premium that's baked into that is going to be much more on the time to wait versus the actual binary event itself. And if we go ahead and we bump out even one more week to December 19th, you can see volatility drops off again, going down into the upper 80s. And if we zoom into that same $39 strike, again, you're going to keep very similar delta, the 37 delta. So you've gone up a little bit more, but the spread here is $2 to $4.40. So you're really realistically probably looking at about a $3.15 to $3.20 fill. Again, this spread very, very wide. I wouldn't normally trade this if this is how wide it was at market open. Because the market is not open, the liquidity and the pricing isn't really here. So we can't read too much into this spread at this moment. It would be something that we would look at when we go to get filled. So wrapping up here to close this one out, I just want to bring up these 3 bullets that I kind of zeroed in on. Is the prerequisite here is we have earnings upcoming. We've looked at the underlying, we've looked at the price action of it, and it's something that we want to go long on. It's something that we are bullish on, so we are going to sell the put, which is a bullish move. And the higher the delta, the more bullish you are. If you're a little less confident on your bullishness, then you're going to back that delta down when you go to sell it. And that is really where you're going to go with, when does it expire and what strike are you going to go after? For me, because I'm looking for that volatility contraction, I'm going to pick the week that has the most volatility in it, because that means that the majority of that premium is going to be from volatility versus time premium. That will always be the week of expiration, or the week of earnings, that Friday's expiration. Then the next thing you got to ask is, well, what strike price do you want to sell? Now, this depends on how bullish you are and the degree of bullishness and what you're comfortable buying the underlying for. Because remember, if you get assigned, you are going to be on the hook to purchase those shares at that strike price. And this is really going to be up to your own risk tolerance of where you feel comfortable based on price action, based on the premium you're collecting, and you're going to zero in on that. So for me, that's usually going to be about a 25 to 35 delta. If I'm pretty bullish, it's going to be that 35 is I'm going to play it to the top side. Very seldom, although occasionally I might sell higher than that, but pretty much where I'm going to zoom in is that 35 delta. Now, where do you go from there? So you've picked it and you're going to see how much buying power is that going to take from your portfolio. What is the impact of getting assigned at that strike price? And that's where you have to go with how much is this going to cost me to fill in the case of assignment, because you're going to then hold at least 100 shares long at that strike price, because each unit of contract that you sell represents 100 shares. So you sell one contract, you're going to be on the hook for 100 shares, two contracts, 200 shares, three contracts, 300 shares. So what is that position size of holding that long fits your portfolio or the percentage that you want to allocate per that position. And you simply just dial up the quantity of contracts that you're going to sell to reach the strike or reach the threshold of your consumption of your portfolio. So for me, that's going to be probably around the $4,500 to $5,500 buying power hit on my portfolio is going to be where I'm comfortable with that position sizing. So in the case of GitLab, that was 5 contracts. And that's where I'm going to play it. That's what I'm going to lay down there prior to earnings. And then I will look post earnings for either that assignment from being in the money, or I'm going to close it out when it's out of the money and go ahead and pocket the difference, and that up to $925 in this particular example. So hopefully that kind of breaks it down a little bit for you. If you're the type of person that is looking to go long those shares and you happen to have earnings come up, check the volatility on it, because selling that premium is really where you can add just a little bit of extra juice to your trade, a little bit of extra powder. You're going to collect more for it because you're essentially saddling that risk of large movement. And I would argue if you're prepared to go long at those prices anyway, then you're really not taking on a lot of extra risk because you're already willing to purchase the shares at that price. All you're doing is allowing to collect a little bit of extra dollars while you take on that risk for the rest of the market. And it will just kind of lower your cost basis upon assignment. If you don't get assigned, then you get to keep all that money. And it's just an extra bonus for being there. Well, even if the premium selling is not your thing, hopefully you're finding trades out there to make. Good luck, have fun, and remember, think outside the block.